All right, here we are with problem two. So we have treasury stock that we're going to do some journal entries for. And so just to get us started with some of the basics for treasury stock, hopefully you read the book and the chapter on treasury stock. But as a reminder, treasury stock is a company stock that it has previously issued, and now they're later reacquiring it. And so it becomes treasury stock. Companies will buy their purchase their treasury stock for multiple reasons, and some are to increase the net assets by buying low and then reselling high. And so we'll see a sample of that on December 15th. They might do it to support the company's stock price, or they might buy it back to avoid a takeover. Maybe too much of their shares is out there, owned by some shareholders, and don't want to avoid a takeover, so they'll buy back some of their stock. Or they might be buying back some of their treasury stock, so that way they can turn around and give it to employees, reward valued employees with some stock, with some company stock. So those are some reasons. The basics of accounting for treasury stock, and I'll go over this as we do our journal entries. The treasury stock account has a normal debit balance. So treasury stock is actually a contra equity. So we think of contrasting opposite. So treasury stock's normal balance will be a debit. Equities is a credit, right? Treasury stock is recorded at cost, and we'll see that shortly. So that's without reference to the par value. So we'll see in the first part of this problem, they're trying to trick you by giving you par value. We don't even care about that. We're going to record treasury stock at cost, what the company paid to buy that stock back. And the account is reported under retained earnings on the balance sheet, and it's a reduction to equity. All right, because since it's a debit balance. Okay, so let's get into this. So we have the first journal entry that we're going to do here, and it's December 1st. They purchased 1,900 shares of the company's $1 par value stock as treasury stock, paying cash of $5 per share. So I just said that we don't care about this par value. They're just put that in there just to trick you. We care about costs. We're recording our treasury stock at cost. So they bought they bought 1,900 shares at $5 per share. And so that was the cost, $5. And so a little multiplication there, and we get 9,500. Okay, that cost, as a reminder. All right, so let's scroll up a little bit and do our journal entry for December 1st. So we got now treasury stock. Oh, and why am I recording it first? Well, it is a normal balance of a debit. We just reviewed that. And so it's a reduction to equity. And so treasury stock is a contra equity account, and so it has a debit balance. And then we paid cash. There you go, recorded at cost. Not too bad. Let's go ahead. We're going to remember this because we'll reference back to this debit balance later. And so here we have on December 15th now. So they sold 200 shares of treasury stock for cash of $8 per share. So the sale price is $8. So that's going to be how much cash they received. So let's go ahead and do that real quick. So times 8, 2 times 8 is 16. So we have 1,600 for cash received. So when we do our journal entry, we'll know that we got 1,600 cash, so that'll be our debit. And let's keep going. So we record treasury stock at cost. So how much did our treasury stock cost us? It was $5 per share, right? Yep. Oops. $5 per share, right? That was how much we paid for it originally. So that's the cost. And so we're going to reduce 200 shares, and that would be at the cost of $1,000. All right. So let's make a T account here, because that will help us understand what's going on. So let's just draw a little T here, and this is for Treasury stock, and it was originally 1,900 shares, right? And that was 9,500. That was the first part. Let's just remind you again. There it is, the debit. And we just sold 200 shares. And so that was 1,000, right? 200 times 5, the cost. So now, and that was 12.15. All right. And I think our purchase was December 1st, right? Let's remind myself. Yep, December 1st. There we go. That way we have our dates written for us. Okay, so right now the balance for Treasury stock is now a remaining 8,500 if we wanted. Okay, perfect. That way we have a T account for what's going on there. And you could plug your difference for the journal entry, but let's just go over the concept anyhow. So it was $8 per share that was sold for. The cost was $5. So we have a difference, an excess of $3 per share. It was 200 shares. So our excess was 600, right? You could have just said, hey, come on, Debbie, it is just subtraction here. Come on, right? Yes, we could have done it this way and got to 600. But at least we know that it was the excess and how it was analyzed with the price per share. All right, so now we're ready for our journal entries. Actually, I'm going to call this something. All right, I'll write out the full thing in a minute, but that was our excess paid in capital. All right, so we have cash received 1,600. That's the debit. That's the first calculation we did. And then we had Treasury stock being decreased, to decrease with a credit. So that was here in this journal entry here, I mean, in this T account entry, and then also here, the calculation. All right, perfect. And then our plug, you could call it the plug, right? We're out of balance. My debits don't equal my credits. So you could just say, hey, I just do the difference. But we did the analysis up there, and we know that that's the difference of $3 per share, which is $600. And we're in balance. I'm happy there. All right, so let's keep moving on. Let's do December 20th. So I made a little bit of a T account already because it's a long one. And some placeholders so I can try my best to stay organized for you. So we have here sold 1,000 shares of Treasury stock for cash of $1 per share. And it says assume the paid in capital from Treasury stock transactions on December 20th is actually 2,400. All right. So paid in capital PIC from Treasury stock, its normal balance, all right, that's what we're going to assume, is going to be on the credit side for 2,400. So I made a T account with that normal balance for us as a reminder, because we're going to need that as we do our journal entries. All right. So let's not worry about December 15th where it had only a credit. Maybe some other things happen. Who knows? but they're telling me my balance right now on December 20th. So that's the balance I'm going to take. All right. I like, this one's very, it has 4 accounts that are going to be affected. And so I'm going to make some journal entries for this because we're just going to get confused. And so it's better to just have journal entries as we go through the analysis here. So we had 1,000 shares of treasury stock, and they sold it for $1 per share. Okay, so that's the cash that was received, 1,000 shares at $1. And so that is easy math, 1,000. Okay. Oops, that's not right. Cash received. There we go. All right, so that is the cash received. So let's make a T account because we know cash is involved now. And I don't know what the balance is of cash or whatever, but we know that there's a transaction somewhere for cash of a debit being received for $1,000. So at least we have that for ourselves, okay? And then let's keep plugging away here. So then we have our cost with this treasury stock of $5, and so we know 5,000 will need to be reduced for our balance of treasury stock. That's our value for 1,000 shares. And so let's make a T account for treasury stock as well. Let's just go based off of what we know that has happened. All right, so it started off with, we can just look at our T account here, up here, at 9,500, and 1,000 was sold, and so its balance now is 8,500. Let's just write it all out. All right, 12.1, and then 12.15 was 600, was 1,000. Oops, almost wrote the wrong number. All right, and then now we are December 20th, and that was 1,000 shares, and so that was December 20th for 5,000. All right. So we can see there, we can find our ending balance, right? Well, let's just do it here, right? Minus 1,000. Easy. I always say easy math, and then I skip to it, and so you can see what I'm doing, right? 3,500. All right. So that's the whole thing for treasury stock, at least. All right. So we have so far. Let's do another color as we're getting through this. I don't know if we can see the difference. We'll just do this. Hopefully it makes a difference. So we know December 20th, we have this one as a journal entry, and we have December 20th for the cash that was received, the decrease to treasury stock. We only have now 3,500 left for treasury stock. And then now we have this paid in capital. So we're not balanced yet. We have a debit, and then we have a large credit for 5,000. So we need 4,000, 4,000 for debit. Well, I only can take up to what I have for paid in capital for treasury stock. So I only can debit up to 2,400. So let's just go ahead and do that. And then we're going to have to take from retained earnings in order to balance. And so I'll show you that in a second. So we can only zero out our paid in capital, and this is December 20th. It's giving me trouble on erasing. Come on, erase. Well, there you go. And now that's zeroed out. Let's extend that a bit. And so we're not in balance. We have a difference still that we need to balance out. And so we're going to plug that difference to retain earnings. Let's make our circle a green circle as we're continuing on. So colorful. All right. So our difference will have to be plugged to retained earnings. So yeah, that's not good. We don't want to decrease our retained earnings, but unfortunately, we got less cash than what we paid for that treasury stock. We paid $5 per share, and we only got $1 per share for selling the treasury stock. So we don't know I don't know what the balance is of retained earnings, hopefully some credit balance here. But we need to plug our difference to that retained earnings in order to balance because we have only 3,400 for our debit so far, right? The 2,400 plus the 1,000. And so I need 1,600 more. And so I'm going to do a debit decreasing my retained earnings for 1,600. All right, so now I balance. I have all the credits and debits that I need. And so let's go ahead and do this journal entry. So again, this was like a plug. I'm going to write that. All right, let's go ahead and do our journal entry for everything. And we'll save retained earnings for last since that's my plug. So cash that we got was 1,000. So cash received, increase for debit. And then we had the paid in capital from treasury stock, transactions, and we could only wipe out the 2,400 balance. Let's just make some placeholders here as we talk through this. And then we have our treasury. All right, that was the 5,000. All right, the 5,000 here. And so we could see we're out of balance by 4,000. And so you're going to take from the paid in capital. And unfortunately, you only have 2,400.